Hey everyone, welcome to our webinar today, Lower Your Tax Bill, Tips for Self-Employed Individuals. My name is Amanda Brief. I'm the Senior Event Manager here at Right Side Up, and I'm thrilled to be joined by Luke Robinson, the new business advisor at Collective, which is one of Right Side Up's partners who can really help with the upcoming tax season. Before I hand it off to Luke, I just wanted to share a couple of standard housekeeping items. So please note, all attendees are in listen-only mode. However, if you have any questions or any comments, you can put them in the Q&A box. And lastly, an email with the recording will be shared tomorrow afternoon. So if you want to rewatch it or share with any colleagues, you'll be able to share the record, or you'll be able to access the recording. All right, and before I hand it off to Luke, just wanted to share a couple of upcoming webinars that Right Side Up is hosting, because the fun does not stop after today's webinar. So you can use the QR code up on the screen to register for both webinars. So we'll be hosting kind of a two-part series on channel diversification. The first one is on Thursday, October 10th, and we'll be walking through the benefits of adopting a diversified marketing channel mix and really how to tap into new revenue streams. And during our second webinar, which will take place on Wednesday, October 16th, we'll be leading a panel discussion where we'll share, which channels are best for diversifying your marketing mix, including TikTok, LinkedIn, and affiliate marketing, just to name a few. So again, you can use the QR code on your screen to register for each of the webinars. And after this as well, you can just go to rightsideup.com as well to access the webinar registration pages. All right, with that, I think I'm going to hand it off to Luke now to kick off today's webinar. Thanks, everyone.
Thanks so much, Amanda, for the kind words. I feel like a celebrity, and I'm not at all. So it's fun to live in this village. But hello, everyone. Thanks so much for joining me today. And yeah, long story short, I represent Collective. I'm a business advisor for Collective. And you can think of us as essentially, an all-in-one solution for a self-employed individual, specifically someone that needs to be an S Corp. So I'll talk about Collective, but I'll also talk about everyone's favorite topic, taxes. Everyone loves them. I know they're the most interesting thing in the world. But hopefully, in all seriousness, we can make it to where your taxes are a little bit lower this year. Hopefully some of this information will help you do that. So let's go ahead and get started. And the agenda. The first thing, we'll go over self-employed taxes 101. What does it mean to be self-employed in a tax context? How does it differ from having a W-2 job or being employed full-time? Then we'll talk about S Corps. And S Corps, that's essentially Collective's bread and butter. And an S Corp is pretty much the next, best step for a lot of entrepreneurs once they reach a certain income level. So we'll talk about how S Corps can help you save taxes and hopefully make taxes less of a burden to an S Corp. Then we'll go on to how do you even estimate your taxes? How do you calculate? How do you know what you're supposed to pay the government? When you're self-employed, it's a lot harder than when you have a W-2 job. And then, of course, shameless plug, we'll talk about Collective and how it makes all of this a no-brainer. And then at the end, you will be able to ask me some questions. We'll have a Q&A session, and you can ask me any tax question under the sun, and I'll do my best to answer. Okay, well, let's get going. Good thing to mention, consider this webinar educational. Don't consider it, official tax advice, official legal advice. The tax code is extremely complicated. So, some of this stuff, might not necessarily apply to your specific situation. So, before you do anything, like before you act on this information, speak to a tax attorney, some sort of tax professional before you do anything. But first, a word about Collective. We're the first all-in-one financial platform that kind of does the whole shebang, when it comes to tax, bookkeeping, formation, and support context throughout the year. Here's your money when you're self-employed. Long story short, it's all over the place. When you're self-employed, first of all, you have to know how to even set up your business. Am I set up properly? Do I need something more? Do I need some sort of legal structure? How does that play in? You have to know how to finalize your financial reports each month. If you don't, it's really hard to, file taxes at the end of the year. You've got to know how to estimate your own taxes. Because, when you work a W-2 job for somebody else, it's really easy to pay your taxes because they're already coming out of your check. They're already being paid to the government. And now you got to do that yourself when you're self-employed. You got to handle bookkeeping. With an S Corp, you have to handle payroll, and so on and so forth. There's a lot of things you got to juggle when you're self-employed. When you need to make a financial decision, all these things are interrelated or interconnected. So if you need to go buy a house, get a loan, your tax is affected and your business finances affected. If you are applying for any sort of business credit, that affects it, and quite a bit of other things. Here's your money at Collect. One easy, straight line, organized line. And thankfully, like with our all-in-one sort of platform nature, we handle the whole shebang. So, instead of needing, multiple professionals, maybe an accountant over here, a bookkeeper over here, instead of needing, multiple softwares, like maybe a payroll processor over here and a, accounting software over there, Collective provides it all in one spot. Okay, here's a poll question. And the poll is, what stresses you out the most when it comes to taxes? And we've got a few options here. And I always like to guess and see which one will win, but I'm always wrong. But I'm gonna try it anyway. So like, what stresses you out the most when it comes to taxes? I'm gonna say having clean books. I'm gonna say, I'm guessing that that's gonna win. We'll see if I'm right. Now I'm nervous because I'm probably gonna be wrong. But that's okay. Life is short. All right, we can probably end the poll if possible. Oh, I was extremely wrong. Okay, so tax preparation and filing is the most confusing thing, which I totally understand. And by the end of this webinar, hopefully it's a little bit more clear. All right, let's get into some basics of what it means to be self-employed in a tax context. Let's talk about the actual taxes that you pay when you're self-employed. One of these groups is the income taxes. And essentially what it is, these are marginal tax rates. And it's what most people think of when they hear taxes. They think of the income tax. And the individual rates or the marginal rates are between 0 and 37%. And when I say marginal, I mean different chunks of your income are charged different tax rates. So for example, let's say that you make $100,000 a year. The first $10,000 of your income might be charged 10%. And then from $10,000 to $30,000, that chunk of money might be charged 12%, and so on and so forth. So that's how marginal tax brackets work, and that's how the income tax works. The self-employment tax is something completely different. It's a flat tax rate. It's just a flat tax rate of 15.3%. And I'm getting ready to blow your mind. Get ready. The self-employment tax is another word for Social Security and Medicare taxes. It's literally what it is. So when you work for someone else, like as a W-2 employee, you still pay the self-employment tax in effect because you pay the Social Security and Medicare tax. It's even the same tax rate, but it's 15.3%. But the only difference is when you're an employee, your employer pays half of it, and then you pay the other half. But when you're self-employed, you pay both halves. And that's why, this right here, the self-employment tax is one big reason why when someone goes self-employed, they think they're drowning in taxes. Because honestly, they probably are. Like when you compare a W-2 job, even if you're making the exact same money as a self-employed person, you're paying more taxes naturally when you're self-employed. Like I just mentioned, this is why taxes are so expensive. It's because of the self-employment tax. If you're an employee, and again, this example has to do with someone who's making around $100,000. When you're an employee, you only pay $7,500 of the self-employment tax because you only pay half. You're self-employed, double that, goes up to 15,000. Let's talk about structure and how they work. If you're a sole proprietorship or an LLC, this is how you calculate your net income. And your net income is essentially all the money you've made minus your business expenses. That's what we mean by tax deductions. So like, let's say that you're a marketing professional and you work from home a lot, like I'm sure you do. You can write off the home office deduction. You can write off a portion of your mortgage interest, your utilities, your cell phone bill, all of that. You can write off traveling costs and whatnot, but that gets you to your net income. And that's what you're actually taxed on. You're taxed on the money your business keeps, not what you spend. And when you do that, your net income is either profit, it's a positive number, or it's a negative number, which means you have a loss, which means you have more expenses than you have income. And that's totally possible. And then either that profit or loss is reported on your personal tax return, on the owner's tax return, on your Schedule C. And then if you have a profit, the entire thing is both subject to self-employment tax and the income tax. So, when you're self-employed, especially when you kind of remain, a sole prop or an LLC, you pay a lot of money in taxes, no doubt about it. What's an S Corp? That's one of the big reasons why we're here today, right? And like I said, collective, this is your collective's bread and butter. And if you came on board with us, it's because you need to be an S Corp, or it would, be in your best interest. Before we even talk about S Corps, let's talk about legal structures. And essentially, legal structures, it's not an S Corp. An S Corp itself is not a legal structure, actually. A legal structure is either an LLC or a corporation. Those are the two main sort of business structures. You form them with your state. Typically wherever you live, you form them with the Secretary of State's office. And you can either form an LLC or a corporation. It requires, some sort of formal organization process. And, to form an LLC, you literally file what's called articles of organization with your state. And that's what forms the LLC. And then typically, they're also required to file an annual report to the state. Sometimes in certain states, it's a biannual report every 2 years, but mostly it's every year that you're going to file a report. An S Corp, though, is a tax election. And before I say this, unfortunately, the IRS, our dear tax collectors, they're terrible at terminology. They are not very good at naming things. So oddly enough, an S corporation is not necessarily a corporation. An S Corp is not a corp. It's not a legal structure. It's a tax election. So when you form an LLC, when you form a corporation or whatever, you can ask the IRS to tax your business under the S Corp tax rules, but you're still technically either an LLC or a corp. Taxes when you're an S Corp. Here's how it's a little bit different. S Corp owners don't pay the self-employment tax on specifically the business profits. And here's what that means. When you make an S Corp election, like let's say that you first off you set up an LLC, but you get to the point where an S Corp makes sense and you file that paperwork with the IRS. Essentially what happens is that creates an employee-employer relationship between you and your own business. Long story short, you become an employee of your own LLC. Now, you're still the owner, of course, like it's still your business. But for tax purposes, you literally become employed by it as well. And now, since you're employed by it, your business will pay you a salary. It'll pay you a wage, a W-2 wage, just like you'd receive if you work for someone else as a W-2 employee. But the advantageous thing about S Corps is that the only chunk of your earnings that's subject to the self-employment tax is your salary amount, your W-2 salary amount. Whereas before, like if you're just an LLC or a sole proprietorship, it's subject to the whole shebang, the whole thing. So we've already went through the sole proprietorship taxes and kind of how they work and how they're calculated. S corps work a little bit different. Here at the top, you have your revenue, your S corp revenue, just like revenue you've had as an LLC or a sole proprietorship. But then from that revenue, there's two types of thing that the S corp itself can write off. One, it can write off your salary. Whatever you pay yourself specifically in salary, that's what the S corp writes off as an expense. And then the S corp can also just write off all your other standard business expenses, like your home office deduction, things of that nature. The salary, whatever you pay yourself is still subject to the self-employment tax, which in this situation, we're calling them payroll taxes. They're the same thing. However, after you subtract your salary, after you subtract your expenses, your S corp has a profit or a loss. It has a positive net income or a negative net income. And then that profit or loss also flows to your personal tax return. It'll end up being reported on there. And then once it gets to your tax return, you're subject to the income tax on all of this money too. But here's where the tax savings actually come in. Let's kind of get into an actual example. Here on the left, like under the sole proprietorship column, let me point to the wages the profit. The profit is $160,000. And as you can see, this example, these two individuals are making the same amount of money. Sole proprietorship's making 160 grand. The S corp is making 160 grand. But if you look over here at the sole proprietorship column, you can't pay yourself a wage when you're a sole proprietorship. You can't be a W-2 employee, an owner W-2 employee when you don't have an S corp collection. So you can't pay yourself a wage. So all of that money is subject to 15.3% self-employment tax. It's a total amount of 24 grand. It's nothing to sneeze at. It's a lot of money. Your pass-through profit's the same. It's 160,000. And your personal income's the same. It's 160,000. All of it's taxed. With an S corp, it's different. You're making the same amount of money. You're making 160 grand. But for whatever reason, this person thinks that a $60,000 salary is a reasonable salary for them. It works out. So that's what they do. They pay themselves a $60,000 salary. And then only that 60 grand is now subject to the self-employment tax. That's it. So the tax drops from 24,000 to 9,000. It's a tremendous difference. And just making a different tax election, even though you make the same amount of money, nets you $15,000 less in taxes each day. And then the S corp, you have a pass-through profit of $100,000 because you're allowed to write off your wages. And then your taxable personal income, you still pay income taxes and all that money, but you pay less on the self-employment tax, quite a bit less. Okay, let's talk about the salary bit, because it's funny and I get the following question a lot, and the question is, okay, Luke, well, if I'm only subject to the self-employment tax on my salary, then why not just pay myself $1? Why not just put my salary super low and then, just take all the rest of the money out as business pass-through profit and then, as distributions? And my response is because you might get audited. The IRS might not be okay with that. And how the government kind of controls that and keeps that in line is they say that the salary has to be reasonable. So if your business is making that, $160,000 total, but you're only paying yourself let's even say like a $10,000 salary, the IRS would probably not think that's very reasonable. So they could audit your tax return, they could penalize you, they would demand some sort of method and some sort of evidence as to why you picked that salary. And unfortunately, there's no set standard for reasonable compensation. There's no objective sort of method to come up with a reasonable salary. So collective, or some other tax professional can help you pick one. And also, your salary is a tax strategy. And of course, you don't want to, pay yourself so low that it could, arouse audit suspicion. But you also don't want to pay yourself so high that you won't save much in taxes. So the key is to strike a balance and to be reasonable with your salary. Which one is best for you? LLC or S Corp? At kind of what point should you make the switch? And LLCs are typically best for new businesses that have very little earnings. For people that have absolutely no idea how much they're going to make in their first year of business, it's usually best to start off with an LLC. And here at Collective, we give a general recommendation of around $60,000. As long as you expect to make at least 60,000 grand, that would be, what would that be, like $60 million? Like, we all hope we have that. As long as you expect to make 60,000, then that's when we say an S Corp is worth it. An S Corp is best for those who want to maximize their retirement savings. There are some additional strategies that you can do when you retirement strategies rather when you form an S Corp. So that's one thing. Earn more than 60 grand in a year, or 60 grand at least, and then also have enough consistent cash flows to make regular payroll runs as well. Okay, let's talk about estimated taxes. Like, how do you even figure out how much taxes you need to pay? First of all, who pays estimated taxes? When are they required? And long story short, anyone that thinks they could owe $1,000 or more in a certain tax year, then you're required to pay estimated taxes. So a lot of independent contractors, like if you're just 1099, for someone or under a 1099 contract, people who have their own, businesses, officially set up, usually that's people that need to pay estimated taxes as well. People who file sole proprietorships, they could very well need to pay estimated taxes. And LLC owners, like either you own an LLC entirely or you own some ownership interest in an LLC. Sometimes that triggers estimated tax payment requirements. All right, let's get into the basics. What do these things even mean? First of all, the government wants you to pay taxes throughout the year. A lot of people think that taxes are paid at the end of the year, but they're not. Typically they're paid throughout the year. So, when you have a W-2 job working for somebody else, taxes are already being taken out of your check by your employer. And your employer is holding those for you in trust and then paying them over to the government. That's just, by law, what they're required to do. Like I said, you must make these payments if you owe $1,000 or more. If you don't withhold enough tax, or you don't make enough or make an adequate amount of estimated tax deposits, if they could penalize you at the end of the year. You may even be charged a penalty if your tax payments are late, even if you're due a refund when you file your tax return. So even if you end up overpaying the amount of tax in a year, you could still be penalized because you just simply didn't pay them on time, which I think is a little silly, but that's how the IRS works. Estimated taxes are paid the month after every quarter. So for January, February, March, that first payment's due on April 15th. For April, May, June. I'm sorry, for April, May and June, yes, that's when it's due on June 15th, September 15th, and so on and so on. What are underpayment penalties? What are the penalties involved when you don't make your estimated tax deposits? The amount of the underpayment, that's one. The period when the underpayment was due and underpaid. So that also has to do with calculating penalties. And the interest rate that underpayments are sort of established or based on are published quarterly. They go up and down based on what the interest rate environment is in the country. Okay, and let's get into how to actually estimate your taxes. Like officially, how do you even do this? This is what's called the safe harbor rules. And you have to pay the lesser of these following two options. You can avoid a penalty if one, you pay at least 90% of the current year's taxes, like what you currently owe, within that same tax year. So, if you estimate that you will owe 1,000 a grand or 1,000 or more in taxes this year, as long as you pay 90% of that $1,000, you won't get penalized. So $900. As long as you pay $900 throughout the year, you're fine. You shouldn't get penalized. So each quarter, you got to pay $225 each quarter because that's your total amount that can prevent you from becoming penalized. Or you can pay 100% of last year's taxes. So, if you have no idea what your actual tax bill is this year, if you owe $2,000 last year, as long as you pay $2,000 this year, you won't get penalized. So $2,000 divided by 4, that's $500. So on and so on. Also, you can do the actual method to calculate your estimated tax deposits, which means, and this is kind of where the estimation part comes in. Like this is why they're called estimated tax deposits, is because you literally have to estimate your income. So first, you estimate throughout the year, what is my AGI going to be? What is my adjusted gross income going to be? And an adjusted gross income means when you take your total gross income and you subtract expense off of it, like business expenses off of it. So then after you do that, you get your net income. And then, which is another way of saying your AGI, your adjusted gross income. You multiply that net income by your applicable tax rates. You go through and you pull up a tax calculator online. You take that estimated income number and you just make calculations and see how much you're going to get charged. You take that total amount and you divide it by 4. Easy enough, right? That's how you pay your quarterly estimated tax deposits. Okay, good point. Estimated taxes aren't just for the federal government. Certain states have them too. So keep that in mind. Okay, estimated taxes as a sole proprietorship versus an S Corp. How are they different? A sole proprietorship, you don't have any withholding, through a W-2. You're not paying yourself a wage. Nothing's going through a payroll processor. So like there's no tax withholdings that are coming out of your check when you're a sole proprietorship. So you got to estimate the amount of money that you expect to earn during the year and pay estimates on that entire amount. An S Corp works a little bit differently. You pay yourself as an employee with an S Corp. So you literally have a paycheck coming to you. Part of the money that you make comes to you via a W-2 paycheck. And since you have paycheck, you'll have withholdings automatically come out of it. If you're using a payroll processor, if you're using Collective, will help you withhold some money from your check. You can choose to increase your withholdings to account for the year. So even if, like, let's say that you don't want to mess with your estimated tax deposits, you could increase your withholdings on your paycheck with an S Corp, and it should take care of them. If your withholdings are adequate. Okay, starting an S Corp now can help you lower taxes later. Essentially what happens. Oh, okay, well, what it's like on your own when you're dealing with Collective, or I'm sorry, when you're dealing with an S Corp without Collective, an S Corp can be pretty complicated. Unfortunately, the federal government doesn't make it easy. So when you're doing it by yourself, first off, you have to figure out how to properly set up the S Corp, which can be a challenge, in and of itself. You got to get your own EIN number. You have to file the S Corp election paperwork. You have to register, a payroll account with the state. It's kind of a nightmare if you do it yourself. You have to have some sort of bookkeeping software to, handle the S Corp specific accounting. You have to calculate your own reasonable compensation. You have to calculate your own wage. Who the heck knows how to do that, right? Then you got to estimate your own taxes. You got to have a payroll software. It's all over the place when you do it without collective. When you do it with collective, we take care of the whole thing. And think of us as an all-in-one solution specifically for someone that needs to be an S Corp. We'll set it up. We'll handle your bookkeeping and provide bookkeeping software for you to use if you'd like to use. We'll provide you with a payroll processor. We'll close out your books every month. We'll handle your S Corp tax return, and so on and so forth. The whole shebang. We work with people who are sole proprietorships, people that currently don't have anything set up, of course, single member LLCs, people that have already taken that step to form the LLC. We work with them. And then we work with people that are LLCs that are already filing as an S Corp. And then we also give a recommendation, and this is for your benefit, by the way, but we give a recommendation to have at least $60,000 or more in annual net income. Now, it's okay. I've seen some people that are making a little bit less money than that still join collective, but that's what we give as a general recommendation to make it worth it for you, to make the S Corp savings worth it. And then we also work with mental health professionals who can operate under an LLC, specifically. Collective is one login. We're one platform. And before us, usually you'd have several, softwares, maybe even several professionals. You'd have to have an accountant that would file your return every year. You'd have to have a bookkeeper that you'd pay $300 a month to, to finalize your books. Collective does all of that in one spot. And the first thing we do is form the business. We'd set up the LLC, file the S Corp election, get your EIN number, which is essentially a social security number for your business. That's how you can think of it as. And then we'll also draft your operating agreement, which is kind of like, the legal document behind your LLC. We'll do that too. Then we'll take over your bookkeeping. And we close up the books each month. So when it says monthly bookkeeping, what that means is every month we'll give you a profit and loss statement, a cash flow statement, and a balance sheet each month for your books. And that's convenient, but because you're not scrambling at the end of the year to get your finances in order. We'll handle the S Corp specific accounting because it's a little bit more complicated, once you go from an LLC to an S Corp, in an accounting context. We'll handle your accountable plan, which is a specific thing that you have to do with an S Corp. And like I said, we'll handle your monthly financial reports. Also, payroll. Payroll is included with the collective membership, and payroll is a must when you are an S Corp. Even if you don't have any additional employees, even if it's just you still have to run payroll because you are on payroll. So first of all, we'll run payroll for you. We'll also handle paying your contractors and filing their 1099s. That's included in the membership. Payroll tax filings. There's literally payroll tax returns that have to be filed. Those are very important. We'll handle those. And we'll also give you S Corp reasonable compensation guidance. We'll suggest how much to pay yourself in salary. Taxes. We'll also handle your tax returns. We'll handle your S Corp tax return, both for the federal and the state. Some states require S Corp tax return filings themselves. So we'll file those for you. And then, of course, we'll estimate your tax we'll essentially run your estimated tax deposits and tell you when to pay them. And compliance and support. Like I mentioned earlier, when you have a business entity, typically every year, you like an LLC, every year you have to file, paperwork with the state. Sometimes it's every 2 years. But we will remind you of that. And we'll give you links as to where to do that and how to do that. Then, of course, you have a support team here at Collective that you can message at any time for any sort of guidance, advice, or anything like that. Also, if you have an existing LLC, Collective can backdate your S Corp to July 1st of this year. So any money you've made for the past few months, like up until July, can be roped under the S Corp tax rules. So, for people that have made quite a bit of money since then, it can make a big difference in your tax bill. All right, let's move on to the cost. How much do we cost? You've got two ways to pay this subscription. If you go the month-to-month route, it's $349 monthly at will contract. If you pay in full just for like 12 months at a time, they give you 15% off the total price. So then that comes out to around $3,500 a year. Also, there's a one-time sort of setup fee of $199. That'll include getting the bookkeeping cleaned up a little bit, setting up the tools, getting everything structured. And also, Collective is tax deductible. All right. Well, also, something that we like to do here at Collective before anyone even joins is we like to give an opportunity for them to have a conversation with a tax advisor, to go through their situation, to see if an S Corp would be in their best interest, and to see if Collective would be a good fit for their business, essentially. So, before someone even joins, we want to ensure that they'll have a good experience and that they're getting actual benefit from the service. And since you guys are great marketing professionals and we love you so much, we're offering a discount code. And it's RSU24, and it gives you 2 months free. I've been at Collective for quite a while. I've never seen a discount code like that. It's a really good discount code. Obviously, you can schedule a call there, scan the code. You can go to our website, go to this link, and we'd love to talk to you. But now, let's open up the Q&A session. And ask me any question under the sun. And Marissa already has a question. I started freelancing for a part-time contract role with a W-9 in late June and haven't paid any taxes yet. If the estimated taxes were due September 15th, should I submit something ASAP or wait until the next January 15th due date? Honestly, I would go ahead and pay something. I'd go ahead and pay something. If you could, go ahead and make a payment, get it into their system, and you might, and you probably can prevent a penalty if you do that. Especially if this is if this is the first year that you started freelancing and you're going to get a W-9, then sure, you should be okay. You shouldn't be charged a penalty anyway, but just to make sure, I'd pay a little bit. I'd pay some now, and then just make sure that you pay the rest by January 15th. Really good question. Okay, and that might be the only question we have. I'll give it a little bit more time because please, I'm here. Any question under the sun, and I'll do my best to answer. Okay. Well, I think that's the end of our questions. But that's totally fine because you still have an opportunity to speak one of us, to speak to an advisor. And I'm actually an advisor here at Collective. So, hopefully that we'll speak together once you schedule this call. But we'd love for you to. Long story short, even if Collective isn't necessarily the best fit for you, or even if you don't need to be an S Corp yet, we'll be honest about that, and we'll tell you. And we're not in the business of trying to sell you something that you don't need yet, or sell you something that's not in your best interest. So we'll be honest with you. We'll point you in the right direction, and we'll go from there. And you're very welcome, Ellen. Thank you so much for joining. I'm glad you enjoyed it. And like I said, please reach out to us if you ever need some help, would like to have a conversation. But that concludes our webinar today.